Okay. Good morning, everybody. Welcome to the latest episode of Coffee with Bob. I am your host, Christina Hapanowitz. Some of you, I think, are joining us for the first time. Coffee with Bob is a mini webinar series brought to you every other Wednesday morning at 11 a.m. We have been doing this for the past 3 or so months now, and we are trying to grow this thing. So if you guys know of anybody who would be interested in these timely topics and they enjoy a cup of coffee, please do forward this on to them, those emails that I send your way promoting these upcoming episodes. The more, the merrier. All are welcome here. We're really excited for this episode today, a market and economic update. So with me are two guests, Bernard Carter and Bobby Apanowitz, making their very first appearance on Coffee with Bob. We're really excited to have them here today. Bernie is a CFA and a CFP. He is our Director of Investments. Bobby is a wealth advisor and also sits on the investment committee at H&A as well. So that very first market and economic update we brought to you, that was presented by our founder and president, Bob Apanowitz, just about 3 months ago, and that was our first unofficial Coffee with Bob episode. We're really excited to bring this market and economic update to you today. What Bobby and Bernie are going to talk about is the progress we've made from that very first economic update for you guys, how far we've come. They're going to give their perspective, where we think we're going moving forward, and also, just as importantly, we're going to talk about some strategies and tactics that you can take into account or consider as an investor to take advantage of this volatility for you. If you have any questions, please don't wait to submit them at the end. You can submit them throughout the presentation, and you will just use that Q&A box. It's either going to be at the top or bottom of your screen, and we'll be taking your questions at the end. So let's get into it. Bernie. So I mentioned this before. We did a market and economic update about 3 months ago. And at that time, that was early April, things were just, it was pandemonium, a lot of uncertainty, a lot of unanswered questions. The economic hardship was just unfounded. Do you want to explain in your perspective, what that was like, and give some of those facts and data behind that economic hardship?
Sure. Thank you, Chris, and good morning to everyone. Thank you for being with us today. And yes, Chris, you are absolutely right. When we delivered our first market update back in April, it was a very, very somber time. Mm-hmm. And in particular, it was, I think, made even more somber because of the contrast that it presented to what had happened in 2019 and the first couple of months of 2020. If you will recall, 2019 was an awesome year in the markets. Stocks were up 20+%, and the economy was going strong. Employment was very full, and corporate earnings were very strong. And then in February, the COVID-19 took hold in Asia, and it very quickly made its way across the ocean to the United States, and how quickly things changed. Mm-hmm. And what we're looking at on this slide is just a few of the stats that cover what happened in our markets and in our society very, very quickly in March. Some of these stats are just mind-boggling. Like, for instance, 20 million plus jobs were lost in a very, very short period of time, just creating a lot of obvious upheaval for businesses and households. Another big stat here is how far stocks fell. They fell over 35% from their highs to their lows, and it happened very, very quickly. So it was a somber time. It was a difficult time. It's almost even difficult to talk about a little bit, but there it is in black and white.
Mm-hmm. So out of all of these stats here, if you had to pick two out of them that had the most significance to you, at least, what would you say they were?
Well, that's a good question. Very good question. So the jobs number, the one that I mentioned, obviously that's a huge number.
Mhm.
20 million jobs. The effect that had on households from coast to coast is it's huge. But also the fact above that in the graph here, GDP. GDP is our gross domestic product. It's the total value of things that we create in the U.S. and the services we provide in a given year. And you can see that, I mean, we had a small contraction. Actually, historically, 5% would be a large contraction.
Mhm.
But it's small compared to what the estimate is for second quarter. GDP is a lagging release. It takes a while for it to be measured. So we don't yet know what second quarter GDP was. But the estimate is that it will contract 32%. That is a
Wow.
huge number. I mean, our
Mhm.
economy contracted by 1/3. We haven't seen a number like this in many, many decades. So I think those would be the two stats that stand out most
Yeah.
for us.
Okay, yeah, thanks for that. It is unbelievable. Just as unbelievable though is the rally that we've had so far. Bobby, do you want to speak to this rally and the recovery that we've had so far? You want to speak to some of these points and give that perspective?
Absolutely, Chris. Yeah, the scale and the speed of the rally that we've seen since the March 23rd lows were unexpected, certainly. And certainly was unexpected too that some pockets of economic data recovered like they did as well. And if we are to see any more recovery or rally going forward, it's likely to correspond with progress in combating coronavirus. And we have made progress already, as Bernie was alluding to. The shutdowns that had to occur in the economy did contribute to the slowing of the spread of coronavirus. Also, healthcare companies are still making progress in creating a coronavirus vaccine. And because of these two factors, we have seen a recovery in consumer confidence. We've seen a rebound in oil prices as consumption has picked up again. And we've seen stronger than expected employment data recently. And this is a very important concept. Actually, we have a chart that we'd like to share.
Bear with me. Okay, there you go.
Perfect. So this chart here is showing how many people have filed for unemployment since the beginning of March of this year. Each one of these bars represents 2 weeks worth of unemployment data. And I really like this image because it just shows, what we have gone through with this coronavirus challenge. And if you look at the far left there, those first 2 bars in March, those are relatively normal data points for a healthy and vibrant economy like the one that we had. And juxtapose that to what we saw later in March and early April, it just shows how large an effect these shutdowns had on our economy and how significant that impact was. And having said that too, many economists expected those numbers to persist going into May and June, but that hasn't happened. Less and less people have been filing for unemployment as the months have progressed. Coupled with that, more and more people have been able to go back to work quicker than expected as well. And this favorable employment data has contributed to positive outlooks with GDP growth in the third and fourth quarters.
Mm-hmm. Yeah, I mean, we absolutely still have, work to do and room to, get back to where we were. But this is definitely a positive looking picture considering where we thought we would be right now. Absolutely. I want to talk about this chart too, just to give some more perspective as to how far we've come. So what everyone is looking at here is a 1-year return of daily, is a 1-year history of daily S&P 500 returns. So Bernie mentioned this earlier in the presentation. that drop back in March was over 35% in the S&P. And then from March to early June, the recovery was around 44%. I mean, have we ever seen anything like this before?
It's been decades, Chris, since we've had a quarter with as positive of returns on this scale like we've had here in the second quarter. And again, this just reflects the optimism in the markets and the expectation that we are going to overcome this challenge.
Yeah, and it's incredible. And that is the perfect lead into what we wanted to talk about next. It is incredible. Bernie, did the markets get it right? I think what a lot of people are asking us or asking themselves is too good to be true.
Right, Chris. So that is, in fact, the $64,000 question. We've had this historic fall and then this historic recovery, and many are asking, okay, well, we kind of understand why the fall took place because of all the changes that happened in our economy. But now that we've had the recovery, does the market have that right? Mm-hmm. One way to kind of think about it is, if you were told at the beginning of the year that the economy would shed 20 million jobs, there would be massive shutdowns of business, of schools, and corporate earnings would plummet, and GDP would contract by a third. And then you were also told, oh, by the way, the stock market 6 months later is going to be virtually unchanged from where it started the year. Most people would not believe that. And yet, in fact, here we are today, and that's exactly what has happened. And it has left many asking, is it correct? Is the market move correct? So the answer, I think that it's a balanced answer. There are positives which argue in favor of the market being correct, and then there are some risks that remain that urge caution. Mm-hmm. And we're going to cover both, but this is a slide that mentions the positives that are in play regarding the market move. And I think perhaps the most important is the one at the top of the list. And that is the fact that markets are forward looking. And this is a message that we continually reinforce with our clients who often are trying to connect the dots between current market moves and what's happening in the economy. Mm-hmm. Markets do not really attempt to price in what is happening today. More so, they look to the future, 6, 12, 18 months. And with those binoculars, the market sees those events and attempts to bring those events into today's prices. So what we're seeing with today's markets is a lot of optimism about what's going to happen with our economy. The market is saying that it is predicting that corporations will reopen. Kids are going to go back to school. Businesses are going to, their economic activity is going to pick up, and corporate earnings will follow. So the markets are indeed reflecting that optimism. Also, the second item here, we've had just a historic amount of stimulus that's come from the federal government, trillions of dollars, and there may be more to come. And this has helped immensely in keeping grease, so to speak, on the wheels of the U.S. economy. It has really kept us moving forward during a very difficult time.
Yeah. I mean, there's no doubt, looking at all of these stats, data points here, and taking others into account, that our economy and our country has persevered. Absolutely. Now, by no means are we out of the woods, though. So, Bobby, do you want to talk about, Bernie just talked about some of the positives behind this rally, and then there are still some things that, we believe investors should be taking into consideration as we continue to climb out of this. So do you want to talk to some of these things?
Absolutely, Chris. There are risks in the market right now, and there are always risks when you are investing, whether you're investing in normal times or unnormal times like what we're going through today. And as prudent investors, you always try to be aware of and monitor those risks. That's part of controlling risk and making sure you're not taking on too much of it. But with that in mind, there are two main pockets of risk that we see, one in the markets and one in the economy as it relates to COVID-19 outbreaks. And the first thing, we've been talking for the last few minutes about the rally we've had since the lows set back in late March. And with that, stock valuations have become a little bit stretched relative to their historical averages. We also see some speculative activity in the markets, a lot of day trading relative to long-term prudent investing approaches.
Mm-hmm.
And you couple that with the potential for a second wave of COVID outbreaks and the effect that could have on businesses and individuals. In extreme cases, there could be solvency issues and bankruptcies. And these are some of the short to intermediate term risks that we see today. Long term, our opinion on stocks and the markets and the economy remains intact. We believe it's a matter of when, not if, we overcome this. Having said that, again, there's always the risk of volatility and uncertainty in the short to medium term as well.
So as we continue to move forward, what kind of data points or headlines in the news do you look for, Bernie, Bobby, that signify signs of progress?
Yeah, that's a great question, Chris. Could you please put up the chart again with the jobs numbers?
Yes, absolutely.
Unemployment numbers, if you wouldn't mind. So for me, this picture is worth 1,000 words. The blue bars that are very tall back in March were the historic job losses that took place very quickly. But you see how quickly they begin to shrink. And actually the June bars are a lot shorter than virtually everyone had expected. So we've had a tremendous rebound in employment, much better than expected. And for me, this is the data point that kind of tells it all. If we continue to move in this direction, I mean, this is as good a signpost of a healthy economy as anything out there. So let's hope that we continue to move in the same direction that we've been in with employment.
Absolutely. Thanks for that, Bernie. So, okay, we talked about where we were and how far we've come, and you know, the aspects within our economy and in our country that have supported this rally so far, and also some of those risks and considerations that we still need to think about. First and foremost, we are financial planners and asset managers. So just like in the previous market and economic update, today what we want to leave you guys with are some strategies and tactics that we think you should be taking advantage of as investors, you know, to use that volatility to your advantage. You know, we believe volatility, whether it's in the upward direction or the downward direction, volatility equals opportunity. So Bernie, do you want to, start us off and talk about some of these strategies here?
Absolutely. And what you just said is so important. We do view volatility as opportunity. And today we are seeing a lot of volatility in the market. And we, in fact, have tweaked allocations in H&A portfolio several times this year in response to that volatility. Some of those moves were risk containment and others were capturing opportunity. But what it comes down to is, in terms of perhaps some things that you should consider, is the first one on the list is closely examine your stock allocations. In today's environment, it probably makes sense to pay closer attention and to examine them more often. Things are moving quickly, and you may need to make some tweaks more often to both capture opportunities and manage risk. And in particular, for those investors who are taking income streams from their portfolios, the wide swings in market prices do offer an opportunity to buy low and sell high. and capture market gains that can really augment that cash flow that you withdraw from your investment portfolio. Another thing that investors should pay close attention to today is really go back and confirm the role of bonds in your portfolio, the role of fixed income. I mean, the simple fact is we're dealing with a very low interest rate environment. Yields are still at historic lows. They have persistently remained low, but they've gone even lower with the COVID situation that we're dealing with. And some are asking whether they should abandon fixed income because there's nothing to be made there, and should they in turn allocate more to stocks. You want to think very carefully about that, because the role of fixed income as a stabilizer and as a support mechanism when stocks are weak remains unchanged. Mm-hmm. And that is a very, very important role for those who are uncomfortable with a 100% stock allocation. And that is most of us. So very important to keep that stability in the portfolio. Another feature of fixed income during volatile times is that it is a valuable source of dry powder that can be deployed to buy stocks when they're volatile and they decline at lower prices. And those purchases can fuel higher returns in the portfolio as markets recover. So fixed income continues to fulfill that role. So make sure you go back and confirm and affirm the role of bonds in your portfolio.
Right, great points, Bernie. As Bernie explained, there are two main components to most folks' investment portfolios: the stock allocation and the bond allocation. And we control those through a process that Bernie explained that we call rebalancing. And essentially it's buying low and selling high, which is what we all strive for and hope for. And further, if there's market pessimism, if assets are selling at a discount, that's likely an opportunity to trim from bonds your dry powder and add to stocks. And the reverse is true as well. When there's optimism in the markets, that can be an opportunity to realize some market gains from your stock portion of your portfolio and use that to add to bonds and take risk off the table. Or you can add the cash buckets if you are taking income for, say, retirement or any other need. So those are ways that you can manage the things that we can control. One of the main levers that we can control is your equity allocation, your bond allocations. We can't control what happens in the market today, tomorrow, next week, next month, but we can manage these things so that your investments are in line with your needs. And that's something that everybody should be taking advantage of. It's something that your advisor should be doing for you. We certainly are doing that here. And it's likely something that's happening behind the scenes. But again, very important. Another important concept is to review your plan periodically. And as Christina said, we're financial planners, we're investment and asset managers as well, asset allocators. And we believe the asset allocation should fit into the broader financial plan that you have. And everybody has different long-term goals. We all have different short-term cash needs, and we all have different risk appetites. And with that, your asset allocations should match all of those needs and should be aligned with your long-term goals. And especially in periods where things are moving as fast as they are now, and really periodically throughout the year, you should be reviewing this with your advisor. Your advisor should be proactively reviewing this with you. And that's something that's very important that you can do. And that's one of those other things that you can control to make sure that you're in line with your plan.
Absolutely. Yeah. You said something really powerful. None of us can control the volatility that happens in the markets. What we can control is our response to it. And one person's response is probably going to look a little different from another person's, because that response will be based upon your investment game plan and the overall bigger picture financial or maybe retirement plan that you put together with your advisor, taking into account all facets of your wealth and your net worth. So we really encourage you, you know, even during times of economic strength at the top of the markets, but especially during times of volatility like this, talk with your advisor, see if these, tactics or strategies work for you. And they will be more than happy to talk you through that process of anything that's happening, whether it's behind the scenes or whether it's something that you're taking a more active partnership in. So absolutely talk with your advisor. And that is it for the presentation today. And we have some questions. So we will get into those. Okay, so the first question I have here, because this is a presidential election year, is there historical data that shows how the market will react in the next few months? That's a great question. Bobby, do you want to take that one?
Yeah, absolutely. That is a great question. And again, there's always risk, there's always uncertainty and the possibility of volatility. And those can tend to be heightened in presidential election years. And again, is that a reason in and of itself to adjust your long-term asset allocation needs and goals? No, not necessarily, but when that volatility comes, again, we would like to try to use that to your advantage, take risk away, and provide the potential for enhanced returns. And that's certainly a way that we would try to approach a period like that. Yeah, great question though.
Yeah, good question. Okay, thank you. Next question we have, what have you guys done as an investment committee to manage the accounts that you manage during this time of volatility? Bernie, do you want to take that one?
Sure. Yeah, that's a very good question. So I would answer that in two parts, I think. First thing we did, just recalling that difficult period back in March, first thing we did was communicate. Our investment committee typically meets weekly, but in March, we quickly moved that up to a daily meeting schedule. And there was a period there where we were meeting twice a day. And we were discussing moves in the markets, the expected effects in the economy of COVID, the response of the federal government and what effects it would have, the resulting changes in allocations within client portfolios, and whether or not we should make any adjustments, researching the alternatives. We spent a lot of time communicating internally. And as well, we communicated externally. We placed scores of outgoing calls to clients to review where we were, to take a good hard look at the allocations within accounts, to make sure clients knew of our plan, our strategy to capture opportunities that were available from the volatility, and also to manage risk, just to make sure we were all on the same page and that everyone was as comfortable as they could be during a very tough period. So at the end of the day, we did make really 4 moves within portfolios during the first half of 2020. And that's more trading than we ordinarily would do. And we were essentially we trimmed stocks a little bit in January and February. We were adding stocks in March, and some accounts may have gotten more than one ad at a couple of different dates in March. And then we recently, back in June, we made another trim of stocks. And all of these moves really were primarily reactions to allocations within portfolios. Portfolios were over allocated to stocks in January, February, and here recently. Both of those were on the heels of market rises. And of course, the adds to stocks in March were the result of pretty substantial under allocations as a result of the fall in the stock market. the drop. So those were 3 tweaks we made to stock allocations. We also tweaked the bond portfolio a bit back in May. We added a couple of bond managers that have a little bit more corporate bonds in their portfolio. And that was, there was an opportunity there. Corporate bonds had suffered more in price than we, thought was necessary, along with, the issues in the stock market. Corporate bonds on a much smaller scale it's kind of the baby was being thrown out with the bathwater, we thought. So we made a modest allocation to corporate bonds in portfolios and as a yield boost. And that is, that allocation's actually worked out very well.
All right, great. Another great question. Okay, next question. How do you determine if we are in a recession, and are we still in one now? Bobby, do you want to take that one?
Yeah, that's a great question. So the definition of a recession is 2 consecutive quarters of GDP contraction. And as Bernie said, we had a 5% contraction in GDP in the first quarter. Second quarter data isn't quite out yet, but we're all but sure that, of course, there has been a contraction, of course. So we are in a recession. Having said that, how do you get out of a recession? Well, you need a recovery in GDP, not a full recovery, but a significant recovery in GDP. And if again, we discussed the economic, the consensus amongst economists right now is that we could see growth in the third and fourth quarter. Third quarter growth could be as much as 15%, fourth quarter 8%. And if we did see that, if those expectations were realized, then we would be out of a recession.
Mm-hmm. And that would be the shortest recession in history. Is that right?
Absolutely, absolutely. And there is a long way to go still. Certainly, there are some risks and uncertainty, but if so, that would be.
All right. Okay, it looks like we have one more question. So this question is asking to comment on inflation as a risk that should be considered when investing. Bernie, do you want to speak to that?
Sure. Inflation is a risk. Inflation degrades your purchasing power, your ability to buy what you need to live, because things gradually become more and more expensive over time. So your portfolio needs to keep pace with that in order for you to maintain the same standard of living. Mm-hmm. And generally, inflation, there is a higher risk of inflation ticking up, kind of reading into the question, during times of fiscal and monetary stimulus, which we've seen a lot of out of Washington here recently. So by the textbooks, inflation, the risk of inflation should tick up here. And it's something we need to monitor closely and look out for. And we'll say, however, that the inflation boogeyman has been rumored to be around the corner for a long time and has yet to show up in any major way. We've seen small spikes of inflation throughout this historically low interest rate environment, and it has yet to become a problem. We need to closely monitor it. And yes, all this stimulus raises the risk that inflation will happen, but so far there are no signs of it. Let's stay vigilant, but so far so good on the inflation.
Okay.
You know, if I could add one thing to that too, Bernie, that's the risk of inflation highlights the importance of why you have stocks in an investment portfolio. Stocks have historically been the best hedge against, or the best protection, I should say, against inflation. So again, as much stocks as you are able to or willing to put into to take on in your investment portfolios, that is certainly a hedge against inflation. But Bernie, as you said, in times of stimulus like we have right now. The stimulus we've seen is unprecedented. It is important to remain vigilant.
Mm-hmm. Okay, well, I think that is all the questions that we are getting today. So on the slide here are our emails and our number as well. So if any of you think of any questions that come up from this conversation, from this presentation, please do feel free. Use us as that resource. And we would be more than happy to talk through any of these things in more detail with you or answer any questions that you may have. We really appreciate you all joining us today. Bobby and Bernie, thank you guys so much for being my co-hosts today. It was a lot of fun and great topic, great discussion. And for everyone out there listening right now, of course, we're going to be emailing out the recording for you to watch at your leisure over your weekend cup of coffee. And again, please do feel free to forward that recording to anyone who might be interested in hearing what our perspective is on this amazing rally that we've had so far and where we think we're going. So stay tuned for more episodes. Of course, our next episode is 2 weeks from today, and stay tuned for that topic. And we'll see you guys in 2 weeks. Thanks again for joining us.
Thank you, everybody.
Thank you.